Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make any sort of investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed today are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is 13 straight days. I thought 13 was an unlucky number, but it was 13 straight days, all while because of business travel and a family vacation, the What We Learned in the Markets video series, sat on the sidelines. Now, of course, what I'm speaking about is the Dow Jones Industrial, which was positive for 13 straight days. That is amazing. It hasn't happened since 1987. We were one day away from breaking like a 130-year-old record going back into the 1800s, but didn't quite get it last Thursday. Now, no one compares their portfolio to the Dow Jones Industrial anymore because it's only 30 of the blue chip companies that are trading on the NYSE and NASDAQ. Today, we all use the more broadly based S&P 500. It's a better indicator, in my opinion, of the U.S. economy as opposed to the Dow Jones, which the Dow Jones is just old. It was created in 1896 by Charles Dow and Edward Jones. Edward Jones has become a horrible place to invest. And it does change over time, but it was good for the early part of the century. Now it's not as good. Now, if the Dow does 13 straight days every time we pause this video series for travel, we may just continue to travel a whole lot more if we're just going to keep getting good markets. Of course, that was more of a oops, that happened at the same time. This week saw the Federal Reserve raise interest rates by another 0.25%, 0.25, bringing rates to their highest level in 22 years. We also saw corporate earnings. We're in the middle of that season, and about half of the S&P 500 companies have released their earnings, and nearly 80% of them are topping analyst expectations, according to FactSet. Now, is that good, bad, or indifferent? Well, the 5-year average of earnings beats is pretty high. It's 77%, so we're a little better. This is very important because for companies to continue to see stock growth, you generally need earnings growth, hence earnings beats. Things like margin improvement, which we've seen a lot of this year, can help in the short term, but long term, you have to grow the top and bottom line. Last week, we saw companies like Meta Platforms, which is Facebook, Alphabet, which is Google, announce earnings that surprised to the upside, as well as Intel, so important to the PC chip industry. They returned to profitability. Companies that didn't fare as well this last week were ExxonMobil and Chevron, who they reported quarterly earnings, and after comparing those to last year, they dipped a little bit. Ford struggled after it said that electrical vehicles, their business there, would take larger than expected losses. What about the initial claims for unemployment? Some of you may have been wondering about that in our 2-week hiatus. Where have those been coming in? Well, we peaked at 265,000 initial claims for unemployment earlier in June. And since then, we have been returning to our historical lows. Last Thursday, we came in at 221,000 new claims for unemployment insurance. We haven't been that low since February of this year. So the labor market's still looking very strong. Finally, how did the markets do this last week? Whole point of the video series. This week, we saw the S&P 500, which is our proxy for growth and income, but only when taken together. And let me give you a quick aside here. Watch Amanda Sherritt, our Chief Operations Officer, her video series, The Question of the Week, for a deeper dive into how we compare each of the Dave Ramsey categories. But back to the S&P 500. That was positive 1.01% this week. The Russell 2000, which tracks our aggressive growth, smaller and mid-sized companies in our Dave Ramsey vernacular, that was positive also 1.01%. And finally, the MSCI EAFE, which tracks international stocks, that was positive 0.62% this last week. Point number 2, let's talk about Israel for a moment. One of our tactical investments on the international side of the table, and read my article I wrote this week about international investing, but Israel is one of our tactical allocations there because the international market has lagged behind the U.S. by nearly half to try to improve the performance of that asset class. While keeping the diversification benefit intact that we love, we strategically allocate a portion of the international investments in certain portfolios to certain markets. Israel is one of those because of their growth potential that we're not the only ones to see. As you can see on your screen, global funds have increased exposure in Israel more than any other country in the investment universe. That's incredible. They've had lower inflation than very similar countries, which has helped them sidestep a lot of the 2022 downturn. However, they've been in the news lately, particularly this week and last week, as Prime Minister Benjamin Netanyahu has pushed through a series of laws diminishing the powers of their Supreme Court. Now, to be fair to Prime Minister Benjamin Netanyahu, whom I admire from afar, he and his cabinet claim the changes will help curb the overreach of the Supreme Court in Israel, which has become too interventionist. A quick side note, the hypocrisy of the American liberal media banging on Prime Minister Netanyahu while advocating for Supreme Court expansion in the U.S. to effectively do the same thing because they don't like the worldview of President Trump's Supreme Court picks is hypocrisy at its finest. However, back to the markets. The poster child of Israel's economy is their tech sector, which accounts for nearly 1/5 of the economy, nearly half of its exports, and a quarter of its tax revenues. I've described them to clients in the past as the Silicon Valley of the Middle East. And those include companies like AI-21 Labs, which has teamed up with Amazon to launch its Bedrock AI tool. These and many more are the reasons we want to have an allocation to the Israel economy. However, the recent political unrest does create some questions, something we'll continue to monitor, and something that came up this week as something we are learning about. Point number 3. Last week, we received the first reading of the U.S. GDP number for the second quarter of 2023. Remember, this is the main gauge to see how fast our economy is growing or shrinking. And if shrinking for 2 quarters or more, we're technically in a recession. This quarter's number came in at 2.4%. 2.4%. That's higher than the 2% number we saw last quarter. Consumer spending, which accounts for the bulk of our economic activity, that grew at an annual rate of 1.6% last quarter, helping push GDP higher. In addition, business investment, that grew at an annual rate of 7.7%. Wow, that's huge, especially when you consider the prior quarter, it was only up 0.6%. A large driver of that was spending on chip manufacturing plants by the federal government. More than likely, that's happening in the plants in Arizona and Ohio from Intel, and government spending on electric vehicle factories is also contributing to that number heavily. As you can see from your screen, analyst expectations for the rest of the year look like slower growth for the next quarter and a negative fourth quarter, followed by rebounding in 2024. Less than 1% growth in the next quarter, though, that got me thinking. That got me thinking about my favorite gauge of what GDP is going to look like, the Atlanta Fed's GDP Now model. This model ended estimates at the second quarter at 2.4%. And guess where we came in at? Were you listening earlier? Because if you were, you knew we came in at 2.4%. Right on target, which is why I love this model. Now, the first iteration of the third quarter's GDP Now model, and granted, this will change because it's in real time as economic data is released, it's adjusting their future forecast for GDP for the quarter. But right now, it's estimating 3.5% for the next quarter. So a far cry from Wall Street's their expectations, who are mainly pessimistic, big city elites with political agendas. Oh, shoot, I wasn't supposed to say that. Can we scratch that? Can anybody scratch that for us, please? Let's go to point number 4. Personal consumption expenditures, or PCE. That came out Friday. And it gave the markets a beautiful lift when released. Now, this is the Federal Reserve's primary gauge of inflation, presumably because it's looking at what type of spending and inflation is happening over a wide range of consumer expenses. This report came out Friday, and keep in mind, the long-term average of PCE is 3.31%. That's the long-term average. And last year, we had the high, 1 year ago, came in at 6.98% on PCE. This month's number came in nearly 3%, lower than the 1 year look back and lower than the long-term average. This is even more evidence that inflation is moving closer to the Federal Reserve's goal of 2%. And this report also highlighted that employers are spending 4.5% more on wages and benefits than a year earlier. You know what that means? That means for the first time in a long time, people are getting raises, and they're getting raises in real dollars because the PCE is coming in at 3, it's coming in at 4.5. That's good. This is just one more sign that the Fed, for as late as they were to spot inflation, and as terrible as they made the economy last year by pushing rates up to the moon, is doing a good job of now controlling it and bringing it back down to a sustainable level, 2% that they like. We'll continue to watch the inflation situation week to week to ensure we continue to trend the right way. And if not, we'll hopefully give you the information that helps you understand what's going on in the markets. So hopefully this video series was very helpful to you. If it was helpful to you, can you do us a favor? You can do us a favor by hitting the like button. The like button helps Google and YouTube's algorithms push our content out to more people. Or if you're watching this video on Rumble, you can also hit the like button there. That'll help us on Rumbles with their algorithm. And if you hit the subscribe button, you will be pushed out our content as it comes to you, which is a great way to be one of the first people to watch what we learned in the markets this week or Amanda's Question of the Week video series. So thanks so much. If you would like to schedule a meeting with any of our financial coaches or planners, you can go to the comment section, and there will be a link sitting in the comment section for you to click on. You can schedule a meeting with our coach if you need help with budgeting, debt pay down, how to stay on a plan, how to be held accountable to that plan, or if you have a college student that is getting ready to go to college in their sophomore, junior, or senior year, our financial coaches help you not only save for college like your financial planner will, but save on. That's an important difference. Save on the cost of college. They can help you out with that. As well as our financial planners help you with baby steps 4, 5, and 6. Build a plan to start executing baby step 4 to save in your Roth IRA, 401k, or any other retirement plans you have, as well as figuring out what you do need to be saving for that kid's college, and get that house out of your life in baby step 6. So the grass, my friends, will feel so much different when you go step on it debt-free. Ask any of our friends who are sitting there today. They'll tell you it feels different. Thanks so much. We'll look forward to seeing you next week.